Welcome to the Rosenberg Round-Up. I'm Dylan Smith. In today's episode, we start with a roundup of the week's news and data, which came against a backdrop of a full equity market recovery from the dislocations of a couple of weeks ago. Don't let that fool you though, the cross-asset picture has changed meaningfully. We also have a roughly complete picture of Harris's economic policy agenda, finally, emerging at the Democratic Convention. We'll provide our initial take on that. And we'll also paddle our little macro canoe over to Canada Corner for an update on inflation and the loonie. Finally, in the spotlight this week, commercial real estate stress and the overlooked risk for US banks, especially the regional ones. Let's get into it. We'll start the week in review by reflecting on what has and what has not changed in markets since that fateful Monday a few weeks ago. Now, equities have not only rebounded, they're now up on the month and on the quarter, though the industrial Dow is now outperforming the tech-heavy NASDAQ in a sign that AI hysteria is tempering maybe just a little bit. That said, all measures of market bullishness are through the roof. Worth pointing out that Japanese stocks have come roaring back too, with the Nikkei and Topix both back in the range that they've been trading at for most of the year, although still a bit below where they were going into that yen carry trade reversal. But all that said about equities, bonds are having a great month too. The 10-year Treasury at its lowest level in more than a year, trading somewhere between 3.8 and 3.9%, down around 30 basis points from the level going into the July payrolls report and almost 60 basis points lower than at the beginning of June, while the 2-year note is down almost 80 basis points. At the same time, gold is hanging about near record highs above 2,500 in a sign that the negative relationship between bond cash flows and the yield-free yellow metal may be reestablishing itself. Other major movers this week were oil, which fell nearly 5% on easing Middle East tensions, and the US dollar, which is down more than 1%. So don't let the rebound in equities fool you. This is not the cross-asset picture that we saw before the correction. We have equities, sure, back to where they were, or a little above. But bond yields and the dollar are down significantly, and gold is up against the trend in the rest of the commodity space. Sure, there's been some dip buying, and yes, the BOJ has been signaling a much more dovish song on potential future rate hikes. But the only thing that can explain this change is a major shift in the expected interest rate path. For all the unexpectedly strong retail sales number last week, soothing fears over a possible recession, markets are becoming increasingly confident that the Fed will not only cut rates in September, but that there's a real risk that might be a large cut and that there will be more to come after that. That is positive for equities from a cash flow discounting perspective, and it's obviously good for bond yields and for gold too. Indeed, markets are now pricing in 8 cuts over the coming year, way up from where we were a few months ago. Let's look at what happened in the macro data flow this week to entrench that view. The most important release this week was maybe also the most obscure, and that is revisions to non-farm payrolls from official census data that's been released. We learned that from the period in March 2023 to March 2024, employment growth will be revised down by more than 800,000 jobs. That's down 28% in the biggest revision over a 1-year period since the global financial crisis. The labor market is clearly not as tight as we thought, which will be music to the ears of the dovish side of the Federal Open Markets Committee. And those doves were in song in the second most important release of the week, which was the minutes of the July Fed meeting, where a surprising number of FOMC members were ready to cut rates that meeting. So the chairman clearly had to lean heavily on them to wait until September and after his upcoming Jackson Hole address to deliver that easing. Third, we had more news on the state of the US consumer from earnings reports, and we now have a pretty good picture of what's going on. If you add up the dollar sales levels for the latest quarter from Macy's, Walmart, Target, Lowe's, and Home Depot, they come to 2.8% on a year-on-year basis. But consumer inflation is running a tad higher at 2.9%, which means there's actually been a slight negative trend in real terms. So we're seeing consumers becoming more frugal, and that's even after you consider that it's taken a massive drop in savings to sustain even this level of consumption. Finally, we did have some of the usual mid-month official macro data in the US. We had the University of Michigan Consumer Sentiment Report coming in a bit stronger than expected, all down to extremely bullish views on the stock market and people feeling pretty good about their savings portfolios. That said, all the questions relating to personal finances and job security showed rising anxiety, so something of a mixed report there. The Chicago Fed's National Activity Index, probably one of the most comprehensive measures of the US economy, came in very weak, as did housing starts, where affordability continues to be a big constraint. So a real picture emerging here of the US economy, the labor market not only weakening, but not starting as strong as we thought. The FOMC ready to go, consumer increasingly in a stretched position and relying on just saving to keep spending. Inflationary pressures have completely dissipated, and slack is beginning to really build up. So we can't rule out a 50 beep cut in September, although that's probably not the base case. And we'll have to wait to see what Powell says later today, being Friday, the day we go to air, at his Jackson Hole address. But first, a word from our sponsor, Kalshi, the first and only CFTC-approved financial exchange that helps you trade directly on economic data. Kalshi is offering a contract on that September Fed rate cut coming in at or above 50 basis points. And that contract's currently priced at 21 cents and paying out $1 if that transpires. Kalshi is a liquid market with hundreds of thousands of users that has already racked up more than $500 million in trading. And if you sign up through the link in our show notes, Kalshi will give you a $20 free credit to get you started. We can't move on from the Week in Review without addressing the other big conference this week, aside from Jackson Hole, and that is, of course, the Democratic National Convention, and specifically what we learned about what candidate Harris believes in terms of her economic proposals. We would characterize what we've learned as progressive tax and spend, bordering on populist tax and spend. So the headline measures are a big bump in social spending, including through the earned income tax credit and child tax credit, those going back up to COVID levels, alongside serious incentives to get housing built, as well as financing access to new homes for first-time buyers. This big social spending program would be financed primarily by a rise in corporate income tax to 28% from the current 21% level. For reference, Trump would lower the corporate income tax to 15%. Harris also seems ready to let some of the personal income tax relief that was delivered in 2017 to expire for households with incomes above $400,000. Broadly, we're working on modeling up what the economic implications of the full package would be, so stay tuned for that assessment. But our initial reaction is that the timing of this type of program, given the state of the US economy and fiscal position, is not good. The US is heading into a slowdown. Now is not the time for a big hit to investment and earnings via a corporate tax increase. And what's more, the spending elements being mostly socially oriented, especially those outside the housing market initiatives, are not particularly growth-inducing. And so we wouldn't see massive returns in terms of those programs on future growth and taxes. Additionally, these measures, as is always the case with fiscal policy, will be much stickier than opponents would hope. One thing that we should note left us a bit perplexed were the anti-price gouging measures that Harris floated and then partially walked back. We would view these more as politicking than serious policies. Margins, including in the food space, are already being squeezed. And with disinflation continuing and real wages starting to catch up, political pressure to implement this sort of vague policy will not be strong. Finally, we remind you that Democrats would require an electoral sweep to implement the bulk of this program. So as is the case with the more harmful elements of the Trump agenda, those being potential tariffs and wide-scale immigration suppression, investors should probably be hoping that America's famous checks and balances do their job. Turning to the week ahead, conference season is coming to an end, and the focus can shift back onto the macro picture now. Headlining next week will be personal income and spending data at the end of the week on Friday, but it's a busy week. Until then, that will also carry a lot of secondary releases, including house prices, consumer confidence, and durable goods orders that collectively might change the picture a bit, so please stay alert. Internationally, we have European preliminary consumer inflation numbers Those will be key ahead of the ECB's early September meeting, and we'll be reporting on those too. Now for something a little different, a risk theme that has not gone away but is a bit overlooked in our Spotlight section. We're talking about the plight of commercial real estate and the problems that it poses for the banking sector. We're running a bit short on time, so we'll keep it quick. My colleague Bhavana Chabra, our equity market strategist, published an excellent overview of how to keep issues in commercial real estate in mind when thinking through portfolio construction. Her message is, stick to diversified bank stocks over regional banks and look for quality and credit. In the REIT space, upcoming rate cuts will be supportive, but stick to more stable sectors like health and residential. What's behind that message? Well, the potential for more negative surprises in the office space, which regional banks are badly exposed to. Some stats to back it up. The office vacancy rate is at a record high 20%, and the back to office push has tailed off, so that's likely to go up. Prices in this sector are down 9% year on year, a steeper drop than at any time through COVID and going back to the GFC. That's impacting delinquency rates for commercial mortgage-backed securities, which have doubled over the past year. Small domestic banks have 44% of their lending books in commercial real estate, compared to just 12.7% for the large banks, who also have higher quality underlying assets. And we also know that smaller banks are still in a precarious solvency position due to the effect of high interest rates on their fixed income assets. All of that paints a picture of very real risks in the system that could easily reach a tipping point, especially if the Fed is too slow to move. So don't get complacent. And before we wrap up, a long overdue trip to Canada Corner is in order. We got some highly encouraging inflation data this week, all core measures, of which there are many, sitting in the 2% to 3% range, right within the target band, and all looking very comfortable. This is the latest in a string of dovish inflation reports, and it's becoming increasingly clear that there really are no sources of inflationary pressure outside of the rental market, which in fact cooled off a bit in this report. That means full steam ahead for the Bank of Canada. We expect another cut in their next meeting. Whether or not the Fed cuts and whatever the Fed communicates about the future policy outlook, some are becoming concerned that this means more weakness on the horizon for the Canadian dollar. But we actually think that a rate divergence with the US is pretty much priced in and don't see too much downside. In fact, more dovish views on the Fed lately have meant that the loonie is actually above its major trend lines as the dollar weakens. Not even a strike or lockout in the rail industry could dent the loonie this week, and so those concerns about loonie weakness being a major inflationary risk or growth risk certainly look overblown. That's all for this week. Time for me to sign off. Thank you so much for listening today. As always, please leave a comment or drop us an email if you have any questions you'd like us to address. And don't miss the show notes for a link to a 1-month free trial for all our research, plus a link to our sponsor, Kalshi. I'm Dylan Smith, and that was the Rosenberg Roundup.